Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about GE HealthCare Technologies Inc. Annual Report. GE HealthCare Technologies Inc. offers a wide range of products and services across four key segments: Imaging, Advanced Visualization Solutions, AVS, Patient Care Solutions, PCS, and Pharmaceutical Diagnostics, PDX. The company's imaging segment provides various medical imaging technologies such as molecular imaging, CT scanning, MR imaging, X-ray systems, and women's health products. The AVS segment offers ultrasound solutions for screening, diagnosis, treatment, and monitoring of certain diseases in clinical areas like cardiovascular and comprehensive care. In addition to these services, the company also operates through its Patient Care Solutions, PCS, segment which provides medical devices, consumables, services, and digital solutions including patient monitoring, diagnostic cardiology, maternal infant care, and anesthesia products. The PCS segment also offers digital solutions for various healthcare needs. The Pharmaceutical Diagnostics, PDX, segment supplies diagnostic agents such as CT, angiography, X-ray, MR, single-photon emission computed tomography, and positron emission tomography to the radiology and nuclear medicine industries. These agents are used to increase the visibility of tissues or structures during imaging exams. Overall, GE HealthCare Technologies Inc. offers a comprehensive range of products and services that cater to various healthcare needs, including medical imaging, patient care, and pharmaceutical diagnostics. The decline in GE HealthCare Technologies Inc.'s GEHC stock price over the past year can be attributed to several key factors. Despite beating earnings per share estimates, the company's stock price dropped following its Q3 and Cone 2025 earnings releases. This negative reaction suggests that investors were not entirely convinced by the company's financial performance. Another significant contributor to the decline was the company's concerns over the China market and tariffs. In its Q4 and full year 2025 earnings report, GEHC indicated a decline in China for 2026 due to continued caution in their guidance. The adjusted EBIT margin fell by 200 basis points, primarily due to tariff expenses and an unfavorable product mix. Additionally, analyst downgrades also played a role in the stock price drop. UBS downgraded GE HealthCare shares from hold to sell, citing that the stock's current price did not fully reflect the company's risks. Furthermore, while overall revenue increased, the company's profitability metrics declined, with unadjusted earnings per share contracting and adjusted net income decreasing. These events collectively contributed to the GE HealthCare Technologies Inc. stock price dropping by more than 5.8% over the past year. The decline in profitability metrics and concerns over the China market and tariffs have likely weighed heavily on investor sentiment, leading to a decrease in the company's stock value. GE HealthCare Technologies Inc. market capitalization of $38 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that GE HealthCare Technologies Inc. holds a significant advantage in their industry. GE HealthCare Technologies Inc. trades at a lower price-to-earnings ratio of 18 times and a higher price-to-book ratio of 3.64 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 74% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can have significant implications on its financial performance. On one hand, revenue growth is driven by key factors such as the sales of products and services, which saw a notable increase in 2025 compared to 2024. Contractual agreements with customers also contributed to revenue growth, particularly in the imaging segment. Additionally, acquisitions made by the company had a positive impact on consolidated revenues. On the other hand, revenue decline is driven by factors such as foreign currency fluctuations, which affected revenue recognition and led to a decline in 2025 compared to 2024. Interest rate swaps and cross-currency swaps also resulted in losses for both years, further impacting revenue growth. These factors highlight the importance of managing exchange rates and financial instruments to mitigate potential risks. In conclusion, understanding the primary drivers of revenue growth or decline is crucial for businesses to make informed decisions about their operations and investments. By identifying key areas that contribute to revenue growth or decline, companies can develop strategies to optimize their performance and achieve long-term success. Net income and profit margins. A changing landscape, the net income of a company underwent significant fluctuations between 2024 and 2025. Initially, it decreased due to tariffs imposed in 2025, resulting in a $245 million loss. However, the trend reversed in 2025, with an increase of 4.6% from $1,993 million to $2,084 million compared to 2024. The profit margins also experienced changes during this period. The gross profit margin decreased by 1.6 percentage points in 2025 compared to 2024, while the operating income margin increased by 0.1 percentage points. However, the net income margin decreased by 0.1 percentage point. Tariffs were a significant factor contributing to these changes. The imposition of tariffs led to additional costs and reduced profit margins. Furthermore, global economic instability and geopolitical risks may have further impacted financial results. Regulatory compliance, reimbursement policies, and AI-related challenges also posed threats to net income. Despite these challenges, the company managed to increase its net income in 2025 compared to 2024. The company's financial performance indicates a positive trend in operating cash flow. According to the data on page 45, the operating cash flow for both 2024 and 2025 has been consistently high, with $1,955 million in 2024 and $1,987 million in 2025. This significant increase in operating cash flow suggests that the company is generating sufficient funds from its core operations to meet its financial obligations. Furthermore, the preliminary allocation of purchase price on page 80 shows a total net asset value post-acquisition of $577 million, which matches the total allocable purchase price. This indicates efficient use of capital and minimal waste. The depreciation expense for 2025 was $287 million, as stated on page 114, which is higher than its capital expenditures. This discrepancy suggests that the company's assets are being depreciated at a faster rate than they are being replaced or acquired, further contributing to its positive operating cash flow. Overall, these indicators suggest that the company is generating sufficient funds from its core operations and managing its assets efficiently. The company's debt level has undergone significant changes between 2024 and 2025. On the one hand, the long-term debt increased from $7,449 million to $9,495 million, while short-term debt decreased from $1,502 million to $508 million. Consequently, total debt rose from $8,951 million to $10,003 million. In terms of interest expenses, there has been a mixed trend. On the one hand, interest expenses associated with long-term debt decreased by $76 million, from $616 million to $540 million. However, overall interest expenses actually decreased by only $28 million due to changes in interest rates and foreign currency exchange rates. The performance of various segments and regions in the industry has been mixed. In terms of growth, the PDX segment stood out with a significant increase of 15.6%, followed closely by the AVS segment at 4.3%. On the other hand, the imaging segment experienced a decline of -7.4%. The PCS segment also saw a decrease of 1.2% in growth, which worsened to -39.6% when compared to previous years. In terms of regions, the USCAN and EMEA markets showed strong growth with increases of 6.1% and 7.4%, respectively. The rest of world region also performed well with a growth rate of 4.2%. However, China was an exception, experiencing a decline of 4.6% in growth. The management of the company is optimistic about its future prospects, with a focus on maintaining its adjusted EBIT margin at 15.3% in 2025. This indicates that the company aims to sustain its financial performance despite some slight decrease from the previous year. The revenue growth is expected to be driven by established operations, suggesting that the company will rely on its existing business to fuel future expansion. In terms of strategy, the company has made significant investments in restructuring and acquisition-related costs, which may impact future results. However, these investments are seen as necessary for long-term growth. The spin-off and separation from GE is also expected to have ongoing costs and impacts on earnings, but management believes that this will ultimately benefit the company. Management has taken steps to manage risks through various means, including derivative contracts and pension plan adjustments. The use of derivatives is solely for risk management purposes, not speculation. Additionally, the company has reduced its pension risk by closely aligning plan assets with long-term benefit obligations through a full bulk annuity purchase in October 2025. Overall, the company's outlook and strategy appear to be focused on maintaining financial performance, investing in growth initiatives, and managing risks through various means. The management is confident that these efforts will drive future success and growth for the company. The acquisitions and divestitures made by a company in recent years are notable for their strategic impact on the business. On the acquisition front, the company has been actively expanding its operations through various deals. One significant acquisition was that of Nihon Medi-Physics Co., Ltd., NMP, in the PDX segment, which is expected to complement existing business and drive growth. In addition to this major deal, the company also acquired technologies and businesses that expand or accelerate its existing operations. Furthermore, it entered into a buy-in agreement with a third-party insurance company for its United Kingdom defined benefit pension plan. These acquisitions demonstrate the company's commitment to growth through strategic partnerships and investments. On the divestiture side, one notable transaction was the spin-off of GE HealthCare Technologies Inc. by General Electric Company, GE, in January 2023. This move marked a significant shift in the company's portfolio, allowing it to focus on its core operations while also creating opportunities for growth through partnerships and collaborations. Overall, these acquisitions and divestitures reflect the company's strategic efforts to drive growth, expand its operations, and optimize its portfolio. By carefully selecting and executing these deals, the company is well-positioned to achieve its long-term goals and objectives. The company has demonstrated its commitment to returning value to its shareholders through various means. One way it has done this is by paying dividends, which is a direct distribution of profits to the owners of the company. In fact, the company has paid out dividends in 2025, with a total payout of -$64 million. In addition to paying dividends, the company has also implemented a share buyback program, which allows it to purchase its own shares from the market. This can help to increase earnings per share and boost the value of existing shares for remaining shareholders. The company has indeed authorized a share repurchase program and has made significant purchases under this plan in 2025, with a total cost of -$200 million. There are valid concerns regarding inventory buildup and supply chain disruption. The potential for shortages or delays in diagnostic agents supply, page 6, sets the stage for these issues. Furthermore, the inability to manage supply chains or obtain necessary components or raw materials has restricted manufacturing of products, page 13. Tariffs have also impacted profitability and cash flows, potentially leading to supply chain disruptions and higher costs, page 15. The risk of global supply chains being disrupted due to public health crises and epidemics/pandemics is a significant concern, page 16. Additionally, suppliers failing to meet delivery obligations or ceasing supply altogether can cause material delays and increase costs, page 20. Geopolitical instability may also result in increased costs, delays in product deliveries, and challenges in maintaining service levels, page 38. Indirectly, an increase in inventories may indicate potential supply chain issues or inventory buildup concerns, page 114. While accrued logistics and utilities have increased by $34 from December 31, 2024 to December 31, 2025, suggesting possible supply chain disruptions, page 115. These concerns highlight the need for companies to be proactive in managing their supply chains and mitigating potential risks. That concludes the financial summary for GE HealthCare Technologies, Inc. Feel free to comment below, and I will be happy to answer them when possible.